Hey everybody, it's Pete. Good morning. Welcome to today's Stock Market Live. Today's edition of Stock Trading Pro, obviously we're going to talk about the Fed, Jerome Powell, FOMC, finally taking action and how it's going to affect the markets. Going to talk also about a couple of stocks that have been on fire for about 5 weeks, determining whether or not those are the best stocks to buy now on this deeper pullback. We're also going to talk about Fedex earnings after the close today. Will Fedex earnings be negatively impacted based on supply chain issues like a lot of other people are complaining about now? It's a pretty good argument. I mean, if you had to order anything over the last year, it's been very hard to get something that's not just basically on the shelf. UPS had some pretty good bullish action recently. We're going to take a look at UPS, FedEx, but I think energy stocks are really going to be the bigger area that we're going to take a look at. If you're a regular viewer of the channel, you know that earlier in the week we said that we were looking for a pop from financial stocks. We were looking for a pop as oil was going down in airline stocks and cruise line stocks. And so far this week, all of that has played out. So we've been kind of really on top of the best stocks to buy now, but we were very clear that in our Stock Market Live, we were talking about trade game plans for specifically this week. We weren't making a longer term macro conversation, but here's the big thing. We've been mentioning that we knew the FOMC was coming out. We knew that they were not new, but there was a very high likelihood it was going to end up being 25 basis points. And we posed the question late last week into early this week, was the rate hike already priced in? Was inflation already priced in? And now that that is out of the way, which we all know they're going to be raising again, at least that's what they said in the statement, is that factored in, and now have we cleared the way for a new bullish run? So we're actually going to answer that question today. So stick around. I'll be back in just 1 second. Okay, so thank you so much for joining me here today, everybody. Really appreciate it. Last night we had a new webinar on how to find the best stocks to buy now. If you didn't catch that, we're going to release the replay of that a little bit later in the day today. It's probably around 90 minutes, and we covered a lot of stuff. I got pretty fired up last night. If you've ever been on one of my coaching calls for stock traders, I can get really loud and excited when we talk about new types of financial education that could really make your stock trading account grow. It was pretty awesome. I thought we had a really good time. We had a couple of hundred people on the call live last night, and I'm sure we're going to have a lot more people watch the replay today. So when I release that video today, if you have any questions, obviously you can leave a comment below the video and I'll get back to you. We released a new 14-day boot camp last night. If you're at all interested in finding out about that, you can actually click the link in the description below. So we're going to hop right over. We're going to get right into it. We're going to talk about where the market is right now, where the futures are. This is where we closed last night, yesterday afternoon, after this vicious rally. Now, if you happen to be day trading, it looked like the market and the world was just falling apart right after the announcement came out. Buyers stepped back in. The market internals firmed up, and this was actually what we had yesterday afternoon. Now, one of the biggest things that I try and do every time we do one of these stock market lives is really to give you the context around what it takes to be a consistent trader. That was actually a big question that we had on last night's webinar, was how do I get consistent? And the question really came, the answers really just kept coming back to, I have a strategy or I don't have a strategy. And most of the traders that were frustrated and the market was kind of beating them up right now, it's simply because they're trying to trade every piece of price action, every move up, every move down. And if you think every single scenario in the stock market is the same, then you really have no idea which are the best stocks to buy now, because then everything looks the same to you. So we get into yesterday's price action, and as we started to plummet during this window right here, which essentially from 2 o'clock to 2:30, and let's say even a little bit more than that because there was a little bit of a bounce, our entire community the entire time was saying one thing: let the dust settle, don't jump in, make it obvious, wait for it to be obvious, wait for a little better volume to come back in, then we can start accepting risk on new stocks that we buy before we just jump in hoping it moves in our favor. So what I want to get across to you is the last 90 minutes of the day yesterday, specifically on the day trading side of things. The language that we used last night was fun. We actually showed the screenshot of our Discord community, and a lot of members of our community, once the dust settled, once the announcement got out, once the conversation started to get digested, the last 90 minutes of the day were incredibly fun, profitable, and quite frankly, easier to trade because the news was out, the indecision was gone. Now, how does that translate into what we're doing now? The bigger picture of the market right now is still has bearish order flow. The big thing that we're looking at, and let's actually take a look at the chart just so we can all get on the same page about that. The bigger picture of the market, and you can see the line here, still has bearish order flow. So what we're battling right now, if you remember the game plan that we created on the week, we said that we have longer term bearish order flow. So the smart money has been dumping supply on the market since January of 2022, since the year started. And it essentially created a stock market crash that has lasted almost 2.5 months now that we're midway into March. What the market hates, what the stock market really does not like is indecision. Well, we got the indecision out of the way yesterday where they finally took action. If you remember the last time the Fed made an announcement, they basically announced that they weren't going to do anything, but they were going to raise at the next meeting. So that day, stocks actually rallied very, very hard into the close, similar to what they did yesterday. So buying stocks in that moment as a day trader was pretty exciting, but then we rolled over again and sold off for the next several weeks. This time, I think, is a little bit different because they actually took action. That's the difference. So now when I created my game plan last night, when I made this big list of stocks to buy now for today, it was a little bit challenging because we had a ton of stocks on the bearish side of the market that were actually setting up as new moves to the downside. And this is one of the biggest questions that we get is how do you know the difference between a short covering rally versus this is the start of a new bullish trend? So if we go back over to the charts and we take a look at this big move to the downside, what we're looking at now is this rally here. That's a short covering rally because it came right back down. This rally right here, and it came right back down. Now this rally right here, which actually is being accompanied by pretty decent volume, and yesterday the volume stepped up as well. This is what's going to separate you from frustrated to I know exactly what I'm doing in the market. And again, I'm going to release that webinar a little bit later today. That was really one of the biggest topics of conversation last night. You know, you could call it financial education or whatever you want to call it, but it was very exciting to see the different numbers that people risk per trade. On average, it's between $500 and $2,000 per trade. So now if we keep those numbers in mind on what the risk is, a big part of last night's conversation was, okay, if I accept that risk, can I justify accepting the risk because there's a high likelihood of stocks moving in my favor? So we're gonna break it down. I'm going to show you some of those bearish ideas that are setting up as what we call bear flags, where there's moves to the downside in the big picture, but now have rallied. So what I want to get across is we did a video probably around 2 months ago where we said this is where money goes to die. And I'll actually post this on the live. I'll post this in the replay later, and it'll be up on top. And essentially what we said, we have something called a PCOT, which is known as a potential change of trend. Right now, we are in a potential change of trend. When we rally hard like that, and we're not sure now because that indecision is out of the way, if we're going to go up and push back down, like we've done since January of 2022. We pushed down and paused, pushed down and paused, pushed down and see, we keep pushing down. But now we seem to be finding some bids over here. And yesterday's bullish gap held the bid by the end of the day. So it's really unique situation. Now, the futures are down a little bit right now. Quite a few stocks are down a little bit right now. So we're seeing profit taking off of the rally for the last 2 days. Now, again, if you're not a regular viewer of Stock Trading Pro and our Stock Market Live, hit the subscribe button because what I'm about to show you is kind of important. If you remember on Monday, heading into the day, we had Monday's price action and then specifically Tuesday. Stocks sold off on Monday. And on Monday, we said Tuesday morning, while the market was down, we said 420.89 in the SPY. We needed to see the weekly chart turn green again. If that happened, we can step up to the plate, look for the best stocks to buy now, and buy confidently until we rally up into the Fed and hit that resistance level. If we broke to the downside and could not get above 420.89 from Tuesday on, we said, okay, the market's still bearish. despite what the Fed is probably going to do on Wednesday. Then we'll continue to look for sell shorts, maybe buy the inverse ETFs, because those inverse ETFs go up when the market goes down. So the point that I want to get across here is, and this is not armchair quarterbacking. We talked about all of this on the live videos. You can go and watch it. We talked about it before it happened. Talked about the financials being priced in. We talked about airlines going up for the week. I want to make this clear. It was a short-term trade for the week into the Fed announcement. So now we are coming up to the next part of the trade. And this is the point that I want to make, and this is a big point that we made on last night's webinar, is that when you are prepared to make decisions, I'm willing to bet it's 7:40 in the morning. I am willing to bet that everybody on this call right now works really hard on trying to find the best stocks to buy. I'm sure you go into the stock market, you look for picks, but I'm also pretty sure, based on the feedback that we got last night, that there's something missing. There's just that one last piece that makes trading so stressful for you that sometimes it puts a knot in your stomach and you get angry even sometimes. What we talked about last night was introducing ways to script your trade. So I'm obviously introducing you to that kind of stuff here on these stock market lives, but I want you to understand, and this was a really big topic of conversation on last night's training, was that most people do not script out trades the way that I'm walking you through right now, which is, if this happens, then I plan to do this. If I'm looking for this and this does not happen, then I have plan B. What happens, and what most traders get into trouble, and this was really a big part of last night's conversation as well, was either, number one, you don't have a script at all, and you're just chasing the most recent price action, which is very challenging to be consistent. Consistently seeing your account growth, that was probably the biggest dream last night for everybody who was on the call. The number two part of that is, even if you can pick some stocks, buying near the optimal entry is another problem. So in other words, you're good at picking which side to be on. So it's obvious picking buying opportunities in this case, but you're not really good at reading the tape, and you're buying too late. As soon as you buy, that stock maybe goes up one more day, pulls back on you, gets you out of the trade, and then does exactly what you thought. And now you're like, why me? Every time I buy, it does exactly what I want, but I'm not in the trade. That just simply means what we keep talking about here is the push and the pause. You're buying at the end of the push instead of waiting for the pause. And that pause is where the institutions who stacked that order flow in the first place and pushed it up, that's when they're stepping back and they're looking to see, are there any other buyers here besides me? If there are other buyers, then you see the stock goes sideways. That's the pause. We call that holding the bid. So how does that all play into the market that we're looking at right now? What are we looking for going forward Thursday, Friday, and specifically next week? So we're walking through how to script out the ideas. We are now looking for the market to hold the bid. We are looking for these bearish stocks that have now rallied Monday, Tuesday, and Wednesday to go sideways as opposed to going down. If they go down, that means the buying pressure that we just had over the last couple of days was short covering. So what does short covering mean, and how is that different from saying the stock market crash is over and we could start looking for moves back in the other direction? Well, what that means is, now that we've rallied up to this super obvious resistance level, you can see sellers came right back into the picture again. So we're going to open up somewhere in the middle, maybe towards the top of yesterday's range. What we are looking for is sideways price action. Even if, now this is what's kind of interesting, even if the market goes sideways for the next 2 days, let's say there's no volatility, we're still digesting what Jerome Powell said yesterday, the action taken by the Fed yesterday, 25 basis points. What I want to see right now, and again, this is going forward. We're not back, armchair quarterbacking it. The price action, remember, if I see this, then I plan to do this. I would prefer the market goes sideways on lighter volume Thursday and Friday, which would mean that the short covering is done, the short selling is done, and new buyers are holding the bid. So last end of line short sellers are coming in and they can't push the stock down with the supply that they have on the market because the indecision's now out of the picture. So what I'm walking you through now is a completely different way of looking at things, because we're not saying this is exactly what's going to happen today. What we are doing and what we talked about last night is we are stacking the order flow. We are stacking the argument, and we are relieving ourselves from the pressure of saying, this is definitely going to happen next, and this is definitely what I'm going to do. That is not good trading. Good trading is, this is what's most likely going to happen next most of the time, and here's what I'm definitely going to do. The challenge that most traders is they say, this is definitely going to happen. That puts you in a tough situation, because then you're saying, this is the only outcome I'm allowing in my mind. And if something different happens, then they get in trouble. That's where bigger losses come in, because you never even looked at the other side of the market, the potential of a stock moving in the other direction. And then you freeze, you take much bigger losses, and then you say, trading doesn't work. Trading works. It's up to you to work the system. So that's the price action I'm looking for over the next 2 days. Sideways. If we get sideways and the S&P 500 continues to pause right at this level, that's going to be very constructive for another move higher and finally breaking this move to the downside. Now, best case scenario, we break this a little bit, go sideways, stay above this level here, then we start to make a move towards this level here, which is right around the 444 level. So what's kind of cool is, if I just covered that a little bit too fast for you, definitely go back and watch the video again, because my whole mission with these Stock Market Lives is to raise the level of awareness of what it actually takes to see your stock trading account grow on a consistent basis. It's when you work your butt off, you work really, really hard, and you're not seeing the results you want. It could be something big, but for most people, if you've done the work, if you started to learn chart reading, you know that chart reading is the start, but chart reading is not trading. So what we're putting together now are the pieces of, if this happens, I plan to be a buyer. If this happens, I maybe not be a buyer, and then I'll go and look at, if the market goes down again, then I'm going to look to short sell or buy the inverse ETFs. And we actually got a couple of questions. Which inverse ETFs are you watching? And these are the most common ones that we're trading in our community. So you can see that when the market goes up, these inverse ETFs go down. So I'll just do this really quick. So this is the QQQ reverse. So that's the inverse ETF. So the market went up the last couple of days, so this went down. And you can see the inverse, right? So the Qs went up. Same thing with the S&P 500. The SDS is the one that we're looking at, as opposed to the SPY. So what we're looking at right now are, if the market's going down, members of our community are buying the inverse ETFs because mentally they don't like to short sell. Maybe you have a moral obligation that you don't like to short sell, or you just don't want to. So the inverse ETFs are opportunities to be a buyer while the market goes down. If the market goes up, then you just jump back into some other ideas. So that's how I'm mapping out the game plan. That's how I'm mapping out the next 2 days. That's how I'm mapping out the next week, because then that dramatically shifts which ideas dominate my game plan right now. Some of them right now, quite frankly, and I'm going to show you what I'm talking about, the bigger picture, the larger list of the best stocks to buy right now are actually on the short side. So they're not really stocks to buy, they're stocks to short sell. So we're kind of right in that zone right now where, are we in a potential change of trend, or are we simply pulling back to make another leg down? Inflation hasn't changed. They're definitely raising interest rates again, according to what they said yesterday. So none of that has changed. The challenge now is some of these stocks that have taken a beating over the last 3 months, maybe even 4 months, have they now reached levels where, despite the economic backdrop right now with inflation, consumer prices, employment, all that kind of stuff, now that the indecision's out of the way, does that free us up? Maybe the pandemic is starting to work its way out and more people are starting to go out again. Has that now shifted where there's some incredible buying opportunities after these stocks have taken a beating? We'll talk about this on future live streams. As we do more Stock Market Lives, we're going to do the sector rotation from one to the next and find some of the obvious areas where money's flowing, and then find some stocks. So we're actually going to talk about, we talked about Fedex today. We're going to dive a little bit deeper into Fedex. Fedex earnings are after the close today. This is actually one of the biggest things. Labor shortages, rising costs, and supply chain issues. Here's the numbers that they're expecting after the close today. But getting more into the chart of Fedex and comparing it to what the market's doing, I also want to take a look at UPS, because UPS has actually had some pretty decent buying pressure as well. Now, what's interesting about UPS, you can see on the chart here, one of the top things that we pay attention to is that 50-period moving average. If you understand Dow theory, which really simplifies a lot of what goes on in the market, there's three different trends going on at the same time. There's the longer-term trend, which a lot of people call the longer-term bull or bear market, which is many people use the 200-period moving average. Then above that is the 50-period moving average, which a lot of people like myself who are swing traders use that to determine whether or not those stocks are viable swing trade candidates. And then the last one, according to Dow theory, is the day-to-day fluctuations, I guess you would call them. Most people use the 20-period moving average. The reason I bring all that up is simply because FedEx and UPS are kind of dancing right around that. Now, one thing that should be super clear, and I've mentioned this in the past, we've talked about, is it obvious and how long has it been obvious? And that's going to influence whether or not you determine that now we can justify the risk simply because the profit potential is very high likelihood. Again, I want to keep getting to that conversation where I want to get away from what's definitely going to happen next versus here's what's most likely going to happen next, but here's what I definitely plan to do. Now, I got a comment once about it sounds like you're hedging and you're not making a call. No, that's wrong. What I am doing is saying, here's the highest likelihood of follow through based on the market, based on the sectors, based on what's going on in the individual stocks and those industry groups. If this happens, I plan on sizing up and making those trades. If what I want to have happen does not unfold perfectly, then I go to plan B. It's not hedging. It's not backing off of making a decision. It's actually making definitive decisions, but only taking and justifying bigger trades and holding longer if what I need to see happens. And again, we covered this in a lot of detail on last night's webinar because a lot of traders don't have that much conviction in building out that argument. They simply say, I ran a scan last night, or I saw something on Reddit, or I watched a YouTube video and they bought something just because of what somebody said. If you want your trading stress level to go down like you can't possibly imagine, we talked about this last night, and I know I'm on a video right now. I'm live streaming on the internet. I'm very careful about what I say. Everything we say here is for educational purposes, but the big thing I want to tell you right now, when it's obvious, it's easy to make money. But it can only be obvious if you know what you're looking for in the first place. So the trading part of making money is easy. I can't stress that enough. It's the setting up what you're looking for before the stock market even opens. That's where most people find the challenge because they'll say, I don't have the time to do that work. Well, you know what? You want to run a part-time trading business that brings home the bacon, you got to schedule it. You got to put it on your calendar. I don't know any successful business person that says, I'm just not going to show up. I'm not going to do any of the work, but I still expect to be successful. I'm not even talking about a lot of work, maybe 30 minutes, but it has to be on your calendar every single day, Sunday night through Thursday night, and then you enjoy the weekend. That's what it takes to be successful in the stock market. You just have to put it on your calendar. So now we're going to work our way over into some of those short selling ideas because now, remember, the biggest theme of today, FedEx above the 50-period moving average, but the weekly chart. Remember, we talked about the weekly chart here, and this is the main time frame where we determine if a stock is obvious. Look at what this stock did here. It rallied really hard and then went sideways for 6 months. Then it rallied hard again and went sideways for 6 months again. So this is UPS. So what is the next opportunity in UPS as the world is starting to get back to normal? Will the world, assuming we're getting back to normal, start to influence how UPS is acting as a price? Well, if we get back to normal, will this mean more or less activity for them? Will this increase their revenues or decrease it? Same thing with FedEx and what's going on with FedEx. Will the supply chain issues affect FedEx? So you can see FedEx is clearly not above the intermediate term trend. As a matter of fact, you could kind of make an argument that it's really stuck between 220 and 260. And that's on the weekly chart. So what is the trade in FedEx right now? Well, FedEx is not super obvious. It's really stuck in a $40 trading range. What we need to see FedEx do now is get out of this box in order for us to feel like we're going to be sizing up. So now what I'm looking for in FedEx right now, there's conversations about supply chains, labor costs. Everything is not perfect for them right now, right? So that's in the past. All of that is what happened in the past. So when they're reporting, that's the previous quarter they're reporting. So again, we talk about this a lot. I don't understand. The number was higher. Why did the stock go down? We need now to pay attention to, with all of that backdrop in FedEx, what do they forecast? What do they expect? What is the guidance for the quarters going forward with all of the new geopolitical stuff going on? Is that situation going to decrease what they expect to have happen next quarter? So I am not trading FedEx into earnings. I will be trading FedEx after I hear their guidance, their conference call, and then see what they are going forward, because there's a pretty good trade between 220 and 260 if the numbers come out good. So now just from the price action, now remember, we talked about the market going down and anticipating the Fed making this announcement, and so far we've rallied. So now we have the price action itself telling us what FedEx looks like. So remember, we recognize if the tape is still obvious or if the tape has changed based on what it's telling us. So what FedEx weekly chart is telling us, despite the fact that it's in the range, we had a bullish U-turn, which is a reversal pattern on the weekly chart, followed by a well-bid week. Both of those are short-term bullish over the last 2 weeks. So is FedEx price action telling us last quarter might not have been awesome, but the last 2 weeks, smart money buying on that bullish reversal into the well-bid week? And I want to show you what this looks like, because now we're stacking the arguments that we might have seen a short-term bottom in FedEx here. So this is what we're talking about right here. Last week was a bullish U-turn on the weekly chart. This is the last bullish U-turn the stock had, and that's what happened right there. Okay, that's what we're looking for right now. So we had a bullish U-turn where this candlestick traded below this candle, traded back up, closed green, and closed above the previous week's low. That part of it, that's good, right? That's the first part. But now we want to stack it. Remember, everything we do, we want to justify accepting risk, justify that we built a great argument that what we expect to have happen next has a really good chance of happening. So that's the first part, the bullish U-turn on the weekly chart. So that's 5 days of buying reversed. That's good. But remember what we talked about NEO stock last week and earlier this week. We said, great, but we need to see well bid. Well, that's what we got in FedEx. This week went well bid. Higher highs, higher lows after this bullish momentum reversal. So if this stock turns around, and we go back now out to the daily chart, if this stock turns around, we know that this is the first level of resistance, and then we just talked about the 260 level. So all of those pieces combined, the higher time frames always dominate. That's where order flow is being spent. Real money is being spent from one day to the next, 1 week to the next. And what's the only reason somebody with deep pockets would be paying higher prices? What's the only reason that somebody would push FedEx from $200 to $230? How does that even happen? Let's use Franz as an example. Let's say Franz has a hedge fund. Let's say Ed has a hedge fund. They have a whole bunch of people doing their research. And you know what? FedEx below $200. I know earnings coming out in 2 weeks. Below $200. Let's look at the numbers a little bit deeper. If they come back and say, you know what, cash flows look pretty good at this price. At this level, it looks pretty good. Let's start building a position ahead of earnings. We don't have to guess that they're doing that. And that was a big topic of conversation. We literally read the tape, and now we have 1 day, 2 days, 2 weeks of buying in FedEx. Somebody pushed it up from 200 to 230 into earnings. So remember, the selling happened last quarter. After hours today, FedEx is scheduled to report. So now this is what I'm looking at. I am anticipating FedEx having good earnings and then the stock rallying. And these are the two levels that I'm looking at. Here's the first one. And up here, as we discussed, based on the weekly chart, that's going to end up being the second one around 260. Now, what's kind of cool about that, which makes this really structured, that was another big topic of conversation last night, is if FedEx numbers come out and they stink, that doesn't match what I want to do. So if they come out, they stink, and the market doesn't interpret them well, I'm like, all right, that's not what I wanted. So I just leave it alone. That one sentence is where really a lot of smart traders get into trouble because they desperately want to prove themselves right. They desperately want to prove how smart they are when you should really be focused on, I desperately want to make money. And desperately making money means you keep your expenses, you keep your losses reasonable. And then if those game plans that you mapped out actually follow through, you need to trade with conviction. You need to buy it as soon as you determined was the right price. You need to know if and when you plan to add to that position, and you need to know the bigger picture of the market. If all of that is scripted out, and again, all the scripts are here. If it's scripted out, when the market opens, all you're doing, you're just managing what you already planned to do. You know, raise your hand if you've ever made an emotional trade where you're watching it go back and forth, your heart's pounding out of your chest, and then you make a decision to get out simply because you were nervous, you were afraid the profit was going to be taken away, or it went down to your stop loss and you didn't get out because you're hanging on to the trade because you want to be right. When you script things out exactly the way I just talked about, we just outlined on Monday and Tuesday what we planned on happening for the rest of the week. We just told you that the market is up in that area now where money goes to die, where it's that potential change of trend. So if we're not technically perfect right now on the bullish side, but there's a potential change of trend, that means to me right now there's conflict in the market. So I'm not going to trade bigger share size. It also means on this end, we mapped out what we're looking to see happen over the next week. So if you missed that at the beginning of the call, we actually said, here's the price action that I prefer to see happen to determine if it's short covering versus new buying has now stepped up and held the bid. We also just mapped out an entire scenario in Fedex that if numbers come out good and the last 2 weeks worth of price action, I'll just show you that again on the weekly chart, which is here, which is this bullish momentum reversal and this right here, which is now well bid. If these two reversal patterns follow through on Fedex earnings, then I'm going to start building a position. Okay. That's how I'm looking at Fedex. Now, this is a sheet of ideas. So remember what we just said. I want you to take a snapshot of this because we talked about order flow for the month. We've talked about if the market opens lower today but finds bids again, the best ideas now are stocks that already have bullish order flow while the market in the bigger picture is bearish. Buying weak stocks is a weak trade. You want to buy strong stocks that already have bullish order flow, people already committing serious capital to that, which has pushed it up in the first place. And then you need that list before the market opens. So I want you to take a snapshot of this because these are the stocks that I'm going to be looking at today, actually, in addition to the energy stocks. So the energy stocks have taken a beating over the last 4 or 5 days, which sounds really weird because they were on fire and they couldn't stop going down just a week ago. So I am going to be looking to find spots to buy Chevron and Exxon Mobil today. So I'm going to put this up on the screen, take a quick shot of it, and you can take a look at that. These are the stocks, and you can see this was updated last night. These are the stocks that have order flow for March, this week, which is a relatively short list, and then 2-week momentum where the recent momentum has been pretty strong. But if we go over to the daily charts and we take a look at, I'm going to start out with Exxon Mobil, actually. It was hanging on to the 50-period moving average yesterday. So if you remember, we just outlined Dow theory, and we said the 50-period moving average, that's a big level to watch, especially if you're a swing trader. Well, there's two ideas I'm going to show you. Right now, Exxon Mobil is clinging to that 50-period moving average line in the sand that we watched. So I'm going to be looking to buy them because that's the last level down where I'm still looking to be a buyer of a particular stock. So now here's just something really quick. Last night's call, we also talked about position sizing and how do you know if you have conflict versus you have harmony? How do you know the right position sizing for the initial part of your trade? Something really quick that I could just give you right now, again, financial education, is if it's above the 20-period moving average, which again, going back to Dow theory, that means it's still pretty strong recently over the last 4 weeks, that will be a little bit higher initial position size for me. If it pulls all the way back and it's stuck between the 20-period moving average and the 50, and I'll show you what that looks like in a second, all the way down to the 50, to me, it's still bullish, but it's not full share size. So I want to show you what that looks like, because there was a stock about 2 weeks ago that was really strong. We mapped it out, we game planned it, we talked about it here on the Stock Market Live. Rallied, took off, went into the profit maximizer, our momentum profit maximizer. The stock pulled back really hard, bearish gap into the 50-period moving average. Now, this is where you have to put yourself into the trade. Be like, well, yesterday we talked about 50-period moving average means buy. But this is the difference between putting the pieces together and just looking at one thing and being lazy. I just said bearish gap into the 50-period moving average. That's a lot of selling. So what can you anticipate happening next? Even though it meets the minimum criteria of holding support at the 50-period moving average, bearish gap means more to me than the fact that it's holding on, because that's a lot of selling pressure. So I'm going to show you what that chart is right now. Okay. So we're talking about Philip Morris. Philip Morris, we had this breakout here. Really, if you know classic technical analysis, this is a really nice ascending wedge, but this is the price action I'm talking about right here. This entry right here, and let's actually move this out right there. That's actually one of my favorite entries. So this is actually bringing it home, I think, in a really big way as well. This stock, we had the breakout, right? Boom, through that level, 104, 104.25, rallied $8. Not a bad swing trade on the long side in the current market conditions, right? Pulled back and paused. Now, every day we talk about a push and a pause, right? Pulled back and paused. And I'm like, yes, I can't wait to get involved in this stock. I can't wait to buy this stock. It did exactly what I wanted to do. But now, as we talk about here, most of the ideas that I get in on swing trades, I want it to be moving back in my favor. And I think we talked about this yesterday, which was a buy stop order to get into a trade. Most people understand stop orders because that's a stop loss. A stop loss is if it goes down, you place your stop loss and it kicks you out. A lot of people don't use buy stops to get into trades, and that's what we're talking about here. So what's kind of cool about this as a leveling up the way you think. Leveling up the way you think is, yes, it pulled back to the 50. And if I go to page 12, that says 50-period moving average, I'm still buying. That's lazy. You need to look at the price action just prior to that. Bearish gap. Love the idea. Looking for it to take off and go higher. It doesn't. We have a giant bearish gap. Now I'm saying, okay, all right, maybe one more day it's in front of the 50. Okay, another pause just like this one, still above the 50. So now what am I thinking? I'm like, okay, maybe that bearish gap was a little bit overdone, resetting up for another entry. Very quick. It's stuck between the 20 and the 50, and I'll show you what that means from a position sizing perspective, right? Look at how perfectly stuck it is between there. If it's above the 50, this one would have been a little more aggressive position size. The fact that it's below the 20 but above the 50, this is still a buying opportunity for me, but not full share size. So now these are you have to be saying this to yourself. Okay, what do I want to see? If I see that, I'll trade it. But based on the fact that it's here versus here, that means X for position size. So I still like it at this point. Okay. So now we're looking at here, another bearish gap holding the 50 and then holding the 50, holding the 50. Now, this is where smart traders just run into trouble because you're like, okay, this is great. Page 12 says I buy it when it's at the 50-period moving average. But what's more important, the fact that it's holding the 50-period moving average for a few days, 3 or 4 days, or the fact that we just had a breakout followed by bearish gap. Trust me, that is a monster failed breakout. So the fact that buyers stepped up, could not hold it above at least the breakout level, and we had bearish gap. The 50-period moving average is now off the table. You are not looking to buy that anymore. That's where smart traders need to level up just one step deeper and make another distinction. And this is what happened here over the next week. Simply putting those pieces together, not buying this here, not getting caught on the wrong side of a trade just because you didn't put those pieces together. That is smart trading and leveling up. So we have a similar situation right now here in Exxon Mobil. Bearish gap. Now, it's not multiple bearish gaps. We actually had one over here, but bearish gap now stuck between the 20 and the 50. So it's higher right now. So I will tell you, I am going into the day looking to be a buyer of Chevron and Exxon today for the next swing trade higher. If I get the entry, and I'm not going to get into the exact entry setup right now, if I get the entry, I will start to build a position because it's stuck between the 20 and the 50. If I build that position and it rallies, I'll look to put on another piece to the trade, looking for it to retest those highs. If I put my first piece on, it rallies, pulls back, I take a small loss and I go to the next trade. So it's kind of cool. I'd strongly suggest you watch that part of the video again, because on last night's webinar, we had a lot of feedback from people mostly frustrated about not understanding when to exit trades and not understanding how to properly have the right share size for trades. But we also went one step further, which is why I just taught that, because understanding there's more to it than it's at the 20 or it's at the 50 or we broke a Bollinger Band. You need to take it one step further. And I'll be honest with you, sometimes even just that one step further can make the biggest difference in the world. All right. I'm going to release the webinar video a little bit later today. If you want to learn more about everything that we talked about, there's a link below here about a new 14-day boot camp. If you want to find out about it, click through there, but you can watch the webinar, which will be out here later today. So I hope I gave you a lot of good insights today, because we mapped out a bunch of stuff today going forward. It's going to be kind of fun to watch that on these stock market lives to see how they unfold. So I'd love to hear your trade management of some of the stuff that we're doing as well. So I have to get ready. I have to go over to our other game plan, which starts in about 20 minutes. If it's your first time here to the channel and you haven't done so already, please do me a favor. Make sure you hit that subscribe button so you get updates. The update is coming out a little bit later today as well. And if you found this valuable, please do me a favor, smash that like button. It would mean the world to me. Also, let me know that this is the kind of stuff that you like to watch. Have an awesome day, everybody. I will speak to you soon. Have a great day of trading today.